What's going on, everyone? Charlie here. I feel like it's a good time to talk about Loopring, and we're going to be reading directly from the white paper a little bit, just to better explain what it's all about and what it is. So let's go ahead and take a look at Loopring, a decentralized token exchange protocol. So this is the abstract. Loopring is an open protocol for building decentralized exchanges. Loopring operates as a public set of smart contracts, SMRT, responsible for trade and settlement, with an off-chain group of actors aggregating and communicating orders. The protocol is free, extensible, and serves as a standardized building block for decentralized applications, otherwise known as DApps, that incorporate exchange functionality. Its inoperable standards facilitates trustless, anonymous trading. Its interoperable standards facilitate trustless, anonymous trading. An important improvement over current decentralized exchange protocols is the ability for orders to be mixed and matched with other dissimilar orders, obviating the constraints of two-token trading pairs and drastically improving liquidity. Loopring also employs a unique and robust solution to prevent front-running, which is huge in my opinion. And they describe front-running as the unfair attempt to submit transactions into a block quicker than the original solution provider. Loopring is blockchain agnostic and deployable on any blockchain with smart contracts functionality. At the time of writing, it's operable on Ethereum and QTUM or Quantum with NEO under construction. So the important things to take away from this is smart contracts. The protocol is free, extensible, and serves a standardized building block for decentralized applications, DApps, that incorporate exchange functionality, drastically improves liquidity, and employs a unique and robust solution to prevent front-running. Loopring is blockchain agnostic and deployable on any blockchain with smart contract functionality. Now, smart contracts are a computer program or a transaction protocol which is intended to automatically execute, control, or document legally relevant events and actions according to the terms of a contract or an agreement. And here's the reminder of all the important things right here. So, introduction. With the proliferation of blockchain-based assets, the need to exchange these assets among counterparties has significantly increased. As thousands of new tokens are introduced, including the tokenization of traditional assets, this need is magnified. Whether exchanging tokens for speculative trading motivations or converting to access networks via their native utility tokens, the ability to exchange one crypto asset for another is foundational for the larger ecosystem. Indeed, there is a large potential energy in assets, and realizing this energy, unlocking capital, requires not only asserting ownership, which blockchains have immutably allowed for, but the ability to freely transfer and transform these assets. As such, the trustless exchange of tokens is a compelling use case for blockchain technology. Until now, however, crypto enthusiasts have largely settled for trading tokens on traditional centralized exchanges. The Loopring protocol is needed because, just as Bitcoin dutifully emphasized that in regards to peer-to-peer electronic cash, the main benefits are lost if a trusted third party is still required to prevent double spending. So too are the main benefits of decentralized assets lost if they must pass through trusted, gated, centralized exchanges. Trading decentralized tokens on centralized exchanges doesn't make sense from a philosophical perspective, as it fails to uphold the virtues these decentralized projects espouse. There are also numerous practical risks and limitations in using centralized exchanges, which are described below. Decentralized exchanges, or DEXs, have sought to address these issues, and in many cases have succeeded in alleviating security risks by using blockchains for disintermediation. Now, however, as DEX capability becomes crucial infrastructure for the new economy, there is substantial room for performance improvement. Loopring aims to provide modular tools for said infrastructure with its DApp agnostic protocol. How about that? So the Loopring protocol. Loopring is not a DEX, but a modular protocol for building DEXs on multiple blockchains. That is critical. We disassemble the component parts of a traditional exchange and offer a set of public smart contracts and decentralized actors in its place. Decentralized actors. Wonder who those could be. The roles in the network include wallets, relays, liquidity sharing, consortium blockchains, order book browsers, ring miners, and asset tokenization services. Before defining each, we should first understand Loopring orders. Loopring orders expressed in what we call, or they are expressed in what we call a unidirectional order model, which is a UDOM. UDOM expresses orders as token exchange requests, amount S divided by amount B, amount to sell, or divided by the amount to buy, instead of bids and asks. So they're taking away the bid and ask. Since every order is just an exchange rate between two tokens, a powerful feature of the protocol is the mixing and matching of multiple orders in circular trade. By using up to 16 orders instead of a single trading pair, there is a dramatic increase in liquidity and potential for price improvement. This is the diagram here of the UDOM. Now, the above figure shows an order ring of 3 orders. Each order's token to sell, or token S, is another order's token to buy, or token B. It creates a loop that allows each order to exchange their desired tokens without requiring an opposing order for its pair. Traditional order pair trades can, of course, still be executed in what is essentially a special case of an order ring. How about them apples? Man, shit's pretty cool. So an order ring is valid when all component transactions can be executed at an exchange rate equal to or better than the original rate specified implicitly by the user. To verify order ring validity, Loopring protocol smart contracts must receive order rings from ring miners, where the product of the original exchange rates of all orders is equal to or greater than 1. Smart. Makes a lot more sense now, doesn't it? The SMRT. Now, let's talk about wallets. A common wallet service or interface that gives users access to their tokens and a way to send orders to the Loopring network. Wallets will be incentivized to produce orders by sharing fees with ring miners. With the benefit that the future of trading will take place within the safety of individual users' wallets, connecting these liquidity pools through our protocol is paramount. And these are the ecosystem participants we're talking about. We have the wallet. Now we have the consortium liquidity sharing blockchain, or relay mesh. A relay mesh network for order and liquidity sharing is basically what this is. When nodes run Loopring relay software, they are able to join an existing network and share liquidity with other relays over a consortium blockchain. The consortium blockchain we are building as a first implementation has near real-time order sharing in 1 to 2 second blocks and trims old history to allow for faster download by new nodes. Notably, relays need not join this consortium. They can act alone and not share liquidity with others, or they can start and manage their own liquidity sharing network. Relays and ring miners. Relays are nodes that receive orders from wallets or the relay mesh, maintain public order books and trade history, and optionally broadcast orders to other relays via any arbitrary off-chain medium and or relay mesh nodes. Ring mining is a feature, not a requirement, of relays. It is computationally heavy and is done completely off-chain. We call relays with the ring mining feature turned on ring miners, who produce order rings by stitching together disparate orders. Relays are free in number 1, how they choose to communicate with the other, 2, how they build their order books, and 3, how they mine order rings or mining algorithms. Now let's look at Loopring protocol smart contracts. They are a set of public and free smart contracts that check orders or order rings received from ring miners, trustlessly settles and transfers tokens on behalf of users, incentivizes ring miners and wallets with fees, and emits events. Relay/orders or relay order browsers listen to these events to keep the order books and trade history up to date. Asset tokenization services, or ATS. This is a bridge between assets that cannot be directly traded on Loopring. They are centralized services run by trustworthy companies or organizations. GameStop. Users deposit assets, real, fiat, or tokens from other chains, and get tokens issued, which can be redeemed for the deposit in the future. Loopring is not a cross-chain exchange protocol until a suitable solution exists. But ATS enable trading of ERC20 tokens with physical assets, as well as assets on other blockchains. What do you think? Sounds pretty neat, right? If you want to look at this white paper, I'll link it below. It's about 17 pages long. And it talks about the stuff I didn't mention in this video. It talks about fraud and attack protection, decentralized governance, the LRX token, the fee model, and then you have an appendix with some objectives. So their main objectives, by the way, is make fee payment more flexible, move the friction of requiring a specific fee payment token, ensure the LRC token is coveted and provides real utility to the network, and remain rent-free with all benefits remaining in protocol accruing to every participant. We realize that while incentives are the most powerful force to allow rational actors to organize themselves, mechanisms which optimize for their desired networks behaviors are valuable. So let me know what you think. Have a good one.